Mira Business FM, it's personal finance for the next hour. Don't forget to catch up with everything we do on Facebook, on YouTube. You know the channels. I don't need to go through them. Mira Business FM, just search. And if you want to contact us, info@mira.fm. You can get in touch directly through that email address. James Thomas is an independent financial consultant. We are in part 2, really, of our financial planning fundamentals conversation. It's fair to say. Nice to see you, James.
Good to see you too.
Good to have you back.
Thank you.
Continuing last week's discussion, and we were really looking at how you take a systematic approach to financial planning. So getting your head straight really is kind of that first thing you need to do. So budgeting, saving, investing, risk management to achieve your financial goals. I want to pick apart a few more of the, not advanced concepts, but the next stages today.
Yep, okay.
First of all, though, let's just recap last time. The first thing I wanted to say was, and I know you're going to agree with this because you're going to nod in a second, I can tell. First off, it's never too late to start.
Never. That's
Good.
Absolutely. If you're talking of fundamentals of financial planning, it is never, ever, ever too late.
Good.
I think people often have a belief that, I should have done it. Maybe you should, and quite possibly that is the right answer. However, it's the analogy we like is when to plant a tree. I mean, 20, 30, 40 years ago is probably better, but when's the second best time? Today. Get that seed in the ground, get it growing, get it watered, get it fed, get it building, get it growing. And it's exactly the same with your financial planning.
It's a good analogy, that, because if you're going to get somewhere, most things start by planting a seed, whether it's an idea or physically planting a seed to grow, I don't know, a basil plant.
Yeah, whatever it might be.
Many other examples, of
Indeed.
course.
Whatever. And again, that's half of the battle I would suggest with financial planning. It's finding that key that to unlock a connection to the rest of their life. And to see that it is not an abstract idea. This is real. This is going to happen to them. When you're perhaps 18 years old, life seems so far ahead of you.
Sure.
Suddenly, when we reach our grand old ages, you realise it goes by in a click of a finger.
You're telling me.
And if you're not making provision, it's not optimal, but it's never too late.
Good.
It's
Okay.
always time to start to do something.
Right. So what we did last week was we broke down into kind of practical steps, effective financial planning, the key concepts.
Yes, it's the key concept. But if we recall, we also talked about that blank piece of paper, that fact find. That's even more fundamental to the discussion because that's where those ideas start to build. You start to identify areas that you may have concerns about, or even indeed identify areas that you didn't even realise needed some planning to be addressed.
Yeah, so, and that starts with analysing your current financial situation, doesn't it? That's the first thing you need to do. But we're back again to that point of being really honest. Whether you're sitting down with a financial advisor, talk about money is hard sometimes.
It's very hard. It's one of the last few taboos. As a modern society, many things are now discussed in the open, which is great. Health was often one that people were very resistant to discussing, I think. Physical health, but also mental health. We're thankfully far more open, perhaps still need to be more open, but financial planning, yeah, absolutely. It's one of those areas that people are still, is it because they don't like to think that, or they don't like to compare to others. And again, everything that's discussed with a financial planner is completely private and confidential. I would say to the only other person who will look at that is a compliance person, and they're not judging you. They're making sure you're given the right advice. It's nothing to do with you that they are looking at. It's making sure that I, as the advisor, has given them. So again, I always say that to assure people that there's no judgment. This is your situation, your unique position. Let's review it, let's discuss it, because once you start talking, ideas flow, conversations start. We start to be able to then build a plan. If you're completely secretive and or will not open up and tell ourselves your full situation, it's much, much harder to advise you. And we may even give you the wrong advice because there's something you haven't told us.
Well, this is the thing, isn't it? And it is about that complete honesty, whether it's with a personal financial advisor, somebody like you, or yourself. And, if you lie to yourself, then you're fooling yourself. So
you are. And indeed, that was, again, one of the points we've discussed in previous conversations, that goldfish bowl, putting your receipts in there, looking at that's one of the first areas that we fib ourselves, let's be polite. We don't realise what we're spending our money on, or we do, and we bury our heads and we think, oh no, we haven't done that. And the reality is...
It was under discount.
It was a discount.
It was a deal, I couldn't... Yeah, I know.
It was, I really needed that. Did I?
Yeah.
The buyer's remorse. But nonetheless, we all do these things. We're in a society where, newest is best. Believed to be best.
Oh yeah.
And therefore, if we're not careful, we can get carried away with that wave. And again, part of this plan, or starting to make a plan, is to make yourself aware of these things, because once you are aware, you suddenly start to think, do I really need that? And like we've said before, again, we're not here to say to people, don't enjoy life. That's not the point. But it's just to have that. Be cognizant, be aware, just think for a second where that money is really going.
That's a really interesting point. So financial advisors, there's a stigma attached in a lot of ways. I know, because you face that every day, I'm sure. And you're not saying don't enjoy life. You're saying be sensible. What you're actually advocating is if you do this, you could enjoy your life more.
100%. Because if you've put a plan in place and you know where your money's going, what you're doing with it, actually, I would argue, it makes your life much happier. Because that fear, that concern, that worry, the unknown.
I've dealt with it.
I've dealt with it. It's done. Public speaking. Oh, I don't know about you. I mean, lots of people are afraid of public speaking. But once you've delivered your presentation and it's gone well, that huge adrenaline rush that you get, that was a job well done. And I would argue this is the same. It's one of those things that people put off, and it's then gnawing away at the back of their mind. Once you do sit down and start to make a plan, I would argue you get a huge sense of relief, because you are now in control of your finances.
And if so, that's the starting point. And if you're worried about other people judging you, try to park that, leave that at the door, analyze your situation, be honest with whoever you're with or with yourself.
Well, if I can just interject there, absolutely. A common point or statement that I hear, I haven't got enough money for you to be able to help me. Again, because people have this view that a financial advisor only wants to deal with a certain part of the population, and that couldn't be further from the truth. I love helping people. That's my job. That's what I've done for a quarter of a century. Wow.
That just hit you then, didn't it?
It did, when you put it that way, 25 years. But as I keep saying, every situation is unique, and every conversation is unique, and they're always enjoyable, because you start to discover things about people that you never knew. And also often they discover things about themselves that they didn't know either.
I've told you things that I wouldn't tell my wife. I'm not sure where that leaves us.
No.
Thinking about it. But the point
but that is absolutely.
It needs to be that way.
Yes. And that's the privilege and the position of privilege that I'm in, that people do open up to me and have these conversations that they probably haven't had with the nearest and dearest and loved ones.
True.
Now, whether that's right or not is a different conversation. But
I know, I was going to add a little caveat there. Mrs. Elliott, if you do listen to this or watch this at any point, you know everything, just so that she knows. But it's a really valid discussion, because this is the first hurdle that people have to get through. From talking to you over the years, this is the thing that you've got to get right. And if this first hurdle can be crossed, as it were.
It's often the highest hurdle to cross, to use that analogy, because once you have crossed it, got over it, through it, further conversations are much easier, because you then are in, if not possession of the full facts, but you're on the way to having, and further conversations in the future are far easier, because it's not going to be any more painful or difficult than that first conversation.
Okay, so the hard first conversation is done, then you can start to set some goals, can't
Yes, absolutely.
you? Okay.
Then you start to really, once you've then got a full picture or starting to build that picture, it's then the conversation about goals. And last week we then said about the foundation, which is the protection, and then you move on to the other areas of discussion.
Okay, so we moved through to creating a plan. We talked about budgeting and saving, checking spending, making sure you've got more coming in than is going out, because that's the first thing that will allow you to do that. So it's really about identifying kind of immediate needs, isn't it? It's prioritizing stuff, whether it's wants or needs. Things like holidays or buying a car, starting a family. These are big either purchases or life events, but you've got to be able to prioritize what's important. And that's all part of getting a handle on expenses.
Yes, because once you've done that, those life events, starting a family, a wonderful thing to do, but it's not cheap. And a child is going to cost many hundreds of thousands of pounds, dollars, euros, dirhams, whichever currency. And again, if you have made a plan, often it's unexpected, but nonetheless, if there's provision made for that event to happen, then it becomes so much easier, because again, all you now need to do is enjoy that process, the birth of your most precious.
Yeah. It's funny, I was looking at a picture of my son this morning when he was 2 days old, and it took me back more years than I care to remember. But
when we first met, he was a babe in arms, and now he's taller than both of us, and
22-year-old thug with a beard, I like to say. Who's the burglar living in our house? I've said a few times. But these things happen, and but the point is to get a handle on everything. Is to get yourself to a point where you understand what your spending habits are, to get them under control if they need to be got under control, and to work towards a budget for the short term and then for the long term.
Yes, if we're talking budgeting, absolutely. There's often, again, many different options, but it's to have the basics covered. So the roof over your head, food on the table, bills covered. Then it's to move on to build that short-term saving that we discussed, a 3 to 6 month salary to cover those emergencies, and then it's more the discretionary spend. So again, we'll come back to the point about enjoying life, going out for brunch, going out for dinner, taking the family on holiday. Whether the car fits into that, different, because it could well be an essential for your job. Sure. But nonetheless,
what does fit into that when it comes to cars is how often you change your car, the kind of vehicle you buy,
Indeed.
and that I think we have to factor in, because generally, you start with a banger, then you move on to something a little bit more, then you buy a new car, maybe you buy a sports car. You have to be in a position to handle the stages.
Yes.
Yeah. Okay.
Don't go straight in for the supercar.
No, probably not the best advice. But if you can do it, then do it.
Great.
And then, of course, you're thinking, I guess, reviewing how you want to live in your retirement and moving towards thinking about that.
Yeah. Again, it's one of a huge discussion point, because it's asking yourself, what does your future look like? Or where do you see yourself? And of course, it's
That's a hard question
it's
to
an
answer.
incredibly hard question to answer. Yes, because there are so many variables.
Well, I think it's harder now. Sorry, it's kind of harder now because generationally, I guess I come from a generation where you kind of did one thing and you did that and then you retired and then that was the way it was. That was kind of the mindset. And I think it's a very different world now, in that I can't imagine my kids wanting to work 9 to 5 in an office. I can't see them doing anything other than a mixture of office, remote, slightly entrepreneurial in terms of their mindset, that kind of thing. And I also can't imagine them doing one thing all their lives. I can see them not chopping and changing, but developing.
Absolutely, yeah. They need to be. They will develop. Watching Roddy with what he's been up to the last few years has been amazing. But things that would never even cross my mind. But so entrepreneurial, and just that can do. Let's give it a go. But leading on from that, that's where this discussion becomes even more important, because he's not going to be working for the one company for 40 years with a final salary pension and everything taken care of. He will need to take control of his future, because while he's in control of his working life now, related to that then means he will be in control of his retirement as well.
And so if he doesn't do it, who is going to do it?
Exactly. Who is going to do it? Because no one else is going to. There may be a very small state pension if he's lucky, but again, not something to rely upon. So he needs to, using Roddy as the example, sorry, Roddy, but it's something he would need to start thinking about.
Sure. And the thing is about this, we're taking a very specific example of my son who's nearly finished university, but it applies across the board.
Across the board.
Anybody.
But sometimes it really helps to have that one example. Because he will not be alone. His whole generation now will not have, very few of them will work for one company for the next 40 years and retire at 65 having only worked for that company.
Yeah.
It's very, very unlikely. Well, and as an expat child, he's brought up here, gone back to university in the UK. Will he come back here? Will he go to another country? Will he move around the world over the next 40 years? Probably.
It's entirely possible. He's probably sitting there now thinking, all the pressure. Yeah, thanks.
And again,
thanks,
that highlights another very good point. We don't want this to feel like pressure.
Yeah.
It's just because if that's the hurdle again, remove the pressure, because once you've had this conversation and even if we're not expecting the answers we get now to be necessarily what transpires in the future. But as we always say, if your plan is in place and we sit down on a regular basis to review that plan, we can then adjust it as life takes its course.
Right, okay. I was just thinking there, listening to you talking about that, and these are all kind of the picture-perfect ideal situations that if you do this, and if anybody were to do this from when they leave school, college, university, embark on a career, by the time you're 65, you'll have loads of money. You'll be absolutely fine, have a great pension. Of course, life gets in the way, things don't happen that way. But it just made me think, when you sit down with a new client and you present ideas and you've listened and that piece of paper is full, and you've got a direction to go in, and somebody balks at opportunities, what frustrates you? What kinds of things do you hear from people? And I'm not asking for specific people, just examples.
I think getting their head around the longevity. We live very much in the moment, and when you're talking of, again, to pick on Roddy, but a 40-year term, it's just too long. It's such a long runway that people get, but again, going back to where we started here, suddenly that's in 30 years' time, where we are, that's only a 10-year runway.
Yeah.
So it's just to get people cognizant of what it will happen. Life will happen.
Yeah.
And to start the plan is not to say that this is not fixed in stone and it cannot be adjusted. No. But it's just to be aware. So that's one area, just getting their heads around the timescales. I can't afford it.
Okay. Just start somewhere.
But start somewhere.
Right.
Because again, while your point about building the dream, living on a beach, jet setting around the world, driving fast cars, whatever it might be the complete opposite. You might have a very humble desire just to live simply and not require a lot of money. But either option could well transpire, but if you plan for the jet-setting lifestyle when you end up living the other lifestyle, well, that's great. But if the reverse is the case, then that's very difficult because you won't have time to build the reserves that you need.
Well, either one needs thought, doesn't it? This is
thought.
The point. Wherever you are going, a plan, sometimes life works in your favor and you end up and it's the right thing for you to do. Call it synchronicity, call it whatever you want to do. But heading towards something with a plan in place and getting there is probably more desirable.
Yes, exactly.
Okay.
What other queries do I get? concerns about costs. Again, perhaps getting very technical, but people will get lost in the minutiae rather than looking at that bigger picture. Yes.
That's a trust thing as well, isn't it?
It is a trust thing. And I think as it develops, it builds. That's why I would be going back to our conversation a couple of weeks ago about those failed investments.
Right.
Don't dive in. And a good financial planner would not expect you to sign up for everything on that first or second meeting. This is a long-term working relationship that we're looking to build from both parties. And therefore, if you're being forced or feel like you're being forced to sign something, then it probably isn't the right thing to do. Whereas the right planner will work with you in your timescales, but also will speak to you again on a quarterly basis, half-yearly, annual basis to say, right, we have discussed X, Y, and Z. We've done X and Y. We now need to do Z. Or what? The plan is there. We've done the first item on the agenda. These other items still need to be addressed. What has happened in the last year? Because life moves very fast, as we know. Have you changed jobs? Have you had a pay rise? Have your personal circumstances changed? All of those will lead into those points on the agenda or the to-do list, but they won't stop them being there. You are still going to retire or want to stop working at some point in the future. You are going to have things evolve in your life. So therefore, those points are still there.
Okay, right.
And I think it's just that that's often the other, taking that leap, that hurdle, use that analogy again, taking that jump.
All right then. So that's what we need to do. So that really is kind of it was a longer recap than I thought, but it's so important, I think, to think these things through. It took me years to actually face that point in my life and to make a decision to do something. And I figure I'm not unique in that respect. That's normal.
Very much normal.
Okay. Right then. So you would consider having really got to grips with your financial situation and the spending that you do, and you've got these things in place. Debt-wise, this was the other thing we spent some time on last week, but pay down expensive debt, really get a handle on debt. Think about consolidation if you need to. Build that emergency fund buffer, as you referred to earlier. 3 to 6 months, really?
3 to 6 months is a good amount to build.
Okay, and keep thinking about the future, because the future does come fast. I never listened to the things my father used to say. Who
does?
Well, nobody does, and I guess it's normal. But in a lot of ways, he's right about so many things. I have to admit it now, grudgingly at times. But he used to say to me, enjoy your kids when they're young, and because all of a sudden they'll be growing up. And I was like, yeah, sure. And then of course now I'm thinking, oh, yeah, you were right. But that's one of those things. That's life. But it is, and I don't want to be here kind of preaching at people, because I don't think I don't like listening to that, but pointing out the things that you might want to think about, or you might want to deal with, or the ways that you might, face the hurdle of, really sorting out your finances. I think it's really important to reiterate. And one of the things that we've said for years, is you have to keep pointing out the same thing. It's not something that you can't rehash. You have to keep doing it.
You do. And in our conversations about these conversations, we're concerned that we are keep going over the same ground. But I think it's ground that's so important to go over that it always adds value. There are different points that get raised, and the fundamentals of financial planning are the same. Whichever which way and whatever newfandangled product or solution that might be.
Great word.
It's great, isn't it?
I like it. I know what you mean.
The basics are still the same.
Exactly right. It goes back to, there's a building, you like a nice building with nice Doric columns or pillars on there, and you look at it and it's great, but you got to look at it again because you like the look of it. And that, I'm trying to illustrate the point here. It's not something that it should necessarily just pass you by. At some point, you're going to come back to it. Yes. And it's like that with money as well.
Yes. And that's hence we're going back to the trust issue and the working with someone that you get on with, because you are hopefully going to be working with them for a very long time.
James Thomas is here talking financial planning, the fundamentals. We're going to be talking about investment next at Mira Business FM.
Mira Business FM. Mira Business FM.
Personal financial planning on the morning drive today. I'm Tim Elliott with you with James Thomas, who is an independent financial consultant. He is here. We're talking about we're really continuing the conversation from last week, the real fundamentals of how you get your money in place. We've recapped for a while, analysing where you are, facing the realization, really, setting goals, creating plans for your financial future, budgeting, saving, getting a handle on things, paying down debts, building that emergency cash buffer, and then looking forward to retirement. And the next step, really, James, is investing. It's a huge topic. We're not going to get through this in 20 minutes today, but where'd you start?
Well, quite. Where do you start?
Yeah.
Two ways to invest: lump sum or regularly. So why?
Okay.
So generally, if you've already accumulated an amount of cash, what to do with that? Or if you're at the beginning of your journey and you want to build that, so on a regular basis. They're the two main ways to save.
Okay. And apologies for this, but between the two, if you've got a little bit of cash you can spend, a lump sum is decent. If you haven't, then it's going to be regular.
Yes.
Simple as that.
Simple as that. Yeah.
Okay. And that's kind of the advice that you give to your clients?
Yes.
Okay. That's a good place to start. The thing is, the decision after that is, this is how I want to do it. The next decision is, well, how and where and why, and if you're a total novice, you're really relying on somebody like yourself.
You are, and that's a huge trust and a huge responsibility with us, that we have to make sure we give the right advice, and the right advice for that person. Because while I may have ideas of my own that I think are right, they're not necessarily right for that person. So the first area, I guess, is what we call the attitude to risk, the level of exposure to risk that they're willing to take. Now, to expand that further, so if we're looking at cash, generally that's viewed as a very low risk asset. But I think, as we've discussed before, I often say it has a dripping tap attached to it. What do I mean by that? While the capital is safe in a bank account, unless it's in a very high interest account, and that brings with it its own level of risk, it is effectively losing money. That's the dripping tap. That's inflation affecting. So if you have £100 and inflation's at 3%, or 100 whatevers, dollars, euros, dirhams, in a year's time, a 3% inflation, that cash is effectively worth 97, because it's devalued by that level of inflation.
Right.
And then if you leave it there longer term, that the concept of, what was it, the eighth wonder of the world, compounding, works against you, because that money is devaluing.
Okay.
So that's one example. So again, we've already got very technical there, but why I like to emphasize that is that people will often say to me, oh, just leave it in cash, it's safe. Is it safe? No.
Okay. So, right, I know, I'm with you. So, we've gone from the fundamentals, and that's relatively straightforward.
Yes.
We're now facing the tough stuff. That's
we
the
are.
thing.
Suddenly we're into quite a more detailed level of financial planning.
So this is kind of a scary hurdle to get through.
Hopefully not scary, but yes, it can be, because mindset is it's in the bank, it's a nest egg, it's safe, it's secure, and in certain way, yes, it is. But from an investment view, it's not. You're almost guaranteed to be losing money.
It's not immediately accessible if you're investing, and a bank is. Obviously, you've always got a handle. You can see it. You can almost touch it. You get regular statements. You know it's there, and that's a great position to be in. But
it is.
It's not growing necessarily.
It's not growing.
It doesn't keep up with inflation.
Very unlikely that, I mean, a bank will, not always, but generally pay you a lower level of interest than the rate of inflation, or indeed the rate that the central bank of that currency sets. So the Fed, Bank of England, European Central Bank, etc.
Yeah, so you need to do something. So you need to then look at your time frame, how long you're saving for. You need to look at the needs, i.e. go back to the plan. And as you say, you have to decide how much capital you want to risk, how happy you are with risk, how comfortable you are with risk that you take, and what kind of reward that you're looking for. And I always think that's a really difficult thing. I mean, some people, I guess, will come to you and say, look, I've got this. If I lost it, well, a few would say this, but some would.
Yep, some would.
I've got this. It's fine. Do something. I want a big return. If I don't, it's okay.
And they say that until the proverbial happens.
Yeah, okay.
And then suddenly,
it's your fault as well. But that's a different thing.
That's a different discussion.
Yeah.
But it's the bravado, the risk taking, the getting out. Yeah, we're going to all in on whatever it might be. Because the thought is that is guaranteed, and it's very unlikely that it is.
Yeah.
The various coins that have boomed and bust over the past few years, that's been a huge topic of conversation. But there's individual shares. Listen, I won't pick on any particular companies, but there are many that you can see. Actually, let's talk about mobile phones.
Go
on. Nokia. Back in the late 90s, everyone had a Nokia phone.
Oh, I love them. The batteries last forever.
Yep. Then we all moved on to Blackberries. Blackberries was the darling of the stock market. Look how everyone had a Blackberry.
Yeah.
And then suddenly Apple came along. Who's to say there's in a bedroom somewhere the next beta, let's call it, the next device that we're all going to suddenly progress to in the next 5 or 10 years. And then it would be, what's an Apple? Oh yeah, we always used to use an Apple or a Samsung.
It's a good point, but you can point to that quite easily, because if you said to somebody now, you said to a younger person now, says an older person, do you remember the original iPhone? You look at an original iPhone now, and it's a quaint little device.
It is. But why I use that as just as an example of how things, what seem to be safe bets, share prices booming, up, they're not going to go down. And suddenly, or not even suddenly, but over the course of a few years, you realise that they're no longer the top of their particular market, and their share price reacts accordingly. The financial markets are, if nothing else, very efficient. They will see that they will be looking at numbers far quicker than I can, or indeed my clients can. They're looking at forward projections. They're talking to the CFOs of these businesses. They've got access to data far quicker than we can, and they will see, and the share price will be treated accordingly.
Okay, right.
So that's why I use that as, again, just to give people a flavour. And again, I appreciate you going into a lot of technical detail, but this is quite a technical area, and I just like to make sure people, clients, prospects understand or have some understanding. And again, always have to be conscious that eyes not glazing over, because it's getting quite detailed, but this is a very important area. And why I like to highlight these things, because we then reach the conclusion that we don't know what's going on, therefore we will go to a fund manager who will build a portfolio on our behalf.
Okay.
By a portfolio, I mean, rather than using that example of a particular company, they will go and make a portfolio of shares of stocks, companies, perhaps 50 to 100, and they will then manage those on our behalf. So they are doing all this analysis for us, and then building that portfolio, buying and selling, managing, adjusting the portfolio to keep that level of risk at a level that we are happy with, delivering a level of return that we are happy with, and doing that on our behalf.
Okay.
And that's their sole job, is to examine the market on our behalf.
Okay. Now, we don't have the benefit of foresight. None of us do. And you don't know what's going to happen, but you can make some reasonably safe investments. If you look at, I don't know, property generally goes up, for example, very often a safe investment. Certain other areas, I suppose.
Asset classes, yes. I mean, if we look at some of the key ones, we've mentioned cash, we've briefly discussed bonds, there's property, there's funds. All have their pros and cons, all have their, again, if you would talk to a real estate agent, they would tell you in far more detail than I am able to what's good, what's bad, what's indifferent. And again, if you're looking at real estate, there's commercial, there's personal investments, there's private homes, and then within that you've got houses, apartments,
townhouses, villas, the whole, yeah, absolutely right.
Again, there's a wide range of options that can be invested into. So again, why to take an expert advice in that area?
Okay, let's quickly just look at a couple of definitions.
Yep.
If we're talking about asset classes, an asset class is an area you would put money, essentially, isn't it? I guess that's a definition of that. But you have cash, you've mentioned, that's your money in the bank.
Yep.
Property, clearly, that's your house or a property that you have for whatever reason. What's a fund? What do you mean when you say a fund?
A fund, so as I was just describing, this is a vehicle that buys a portfolio, a range of individual shares to build a fund.
Okay.
So within that, again, a huge universe of options. I think there's 40,000 funds on the planet that can be invested into. Wow. But again, if we were a generalist would maybe track one of the world's indices. So the S&P 500, so the leading 500 shares in the US, the FTSE 100, so the leading 100 shares in the UK. Various other countries have similar indices. And then you can find fund managers that actually then blend all of those indices. So you can get a very, very diversified. You could find that your money is invested into 1,000 individual stocks within one fund. So again, getting quite technical, but the reason for that is you get a level of diversification that you simply could not achieve without many, many millions of pounds, dollars, euros invested. So for a much smaller investment, you can get exposure to the much wider range of investments.
Okay, so that's essentially accessing. So
that's what
markets.
A fund is. So it's a structure, a legal structure, the setup to make sure your money is safe. So the fund manager cannot spend it himself, themselves. They can use it only for your investment. But in investing and what it invests into, again, that's the areas that we would advise and guide.
Okay. A bond. How would you define a bond?
A bond is really a debt, a loan. So rather than a mortgage, which most of us would understand, so we go to the bank and say we wish to purchase a property or we want to buy a car, so we need a loan. A bond is, again, a structure, but this is where a company or a vehicle goes to the market and says, I need to borrow X pounds, dollars, euros to grow my business, to purchase another company, to whatever it might be. And in return for that, you will pay a level of interest.
Okay.
To secure those funds. So if you and I were to set up a company with no track record, we would have to pay a much, much higher level of interest than, say, Emirates.
Okay.
One of the world's largest companies. They wish to buy a new plane or a fleet of planes. They can go to the market and say, we need X million dollars to buy some new Boeing or Airbus. The market can say, well, we know who they are. We know they're very financially secure. They don't have to pay us so much interest in return for that loan. And then at the very top are governments.
Right.
So if the British, American, whichever government want to borrow money, they go to the market and say, we need to raise X million. And again, in return, because they are deemed to be generally a very secure borrower, they don't have to pay a particularly high interest for that.
Okay.
But again, if we're looking at the risk spectrum, and again, there would be experts in those areas who would be able to class those levels. James and Tim Limited would be right at the top because we have no track record. We'd be a relatively small business. We would have to pay that high level and be deemed to be a high risk.
I'm pondering James and Tim Limited or James and Tim LLC at the
LLC,
moment.
yeah.
There's something in that maybe for the future.
Maybe.
But it's
But that's just to give that spectrum.
yeah,
And
exactly.
how that they work and the levels of return that you would expect to receive. Again, in all of these areas of asset classes, the levels of return are based on the level of risk. So
Right.
that small business that's starting up, wanting to raise money, would have to pay a much higher rate because it has no track record. It's viewed as a much higher risk versus that much larger entity, that big company that's got many years of track record, or indeed at the ultimate level, a country, a government that's looking to borrow. And again, that's generally, there have been exceptions, but generally viewed as a much lower risk and therefore would generate a lower return.
So for the last 10 minutes or so, really, we're kind of drilling down into the next step of financial planning, fundamentals of
Yes.
financial planning. And really it is getting a grip on where you go next, understanding what you're doing, understanding or balancing the risk and reward that you are comfortable with, that you want. We haven't really mentioned diversification at the moment, but clearly, it's the old adage, what maybe your grandmother would say, don't put all your eggs in one basket. That's really, really important.
It is, and you hit the nail on the head. Do not put all your eggs in one basket. And that's where a fund becomes so powerful because it allows you as an individual investor to get that wide spread of investment from your monthly or lump sum investment that you simply could not achieve normally as a private investor.
Yeah.
Because your money is pooled with thousands of other investors into the structure and then invested together. So you get the economies of scale because you're pooling with all of those other investors. You're getting a spread across all those, potentially all the asset classes we've already described, built into a portfolio that then again meets your attitude to risk. So again, within these areas, it can be very cautious, it can be balanced, or it can be very aggressive, and they can be selected.
But the thing is, that's a very personal thing, and I think it's something you've just kind of hit on a point there that I've always thought is really important. Markets are kind of the markets, they're things, they're monoliths, they're buildings, they're whatever they are. But actually, markets are just full of people, and people have foibles and wants and needs, and they are emotional, and they make decisions based on how they feel rather than logic or facts at times.
Very much.
Things can change very quickly. So there's an element of, if you're in a fund which has exposure to lots of different areas, it could be a basket of 50 funds or 150 funds, who knows?
Yep.
If one particular area, one small area of that fund isn't looking great, don't panic, because on the other side, there is probably a balance to be struck.
That's the key reason for using a fund, or one of the key reasons. Precisely. So that if there should be an area that is not performing so well, there's likely the other area within the fund is performing better, and therefore you get that balance. Because one thing I've never found yet is that crystal ball that can tell us where the next best opportunity is going to be. So therefore, that is why we spread our risk. That's why we put our money across many different areas of investment, because we just simply do not know what's going to be the best thing tomorrow.
Well, one of the things about financial planning is, and investing is, you have to know when to listen to people and when to absolutely not listen to people.
Yes.
Don't you? It's that, your friend has I've got a great tip, put your money in this, do this. And I always think, perhaps not. So there's that as well. And that comes back to the people element of, your decision is your decision. Take advice, look at it, weigh it up, but try to be completely independent. Don't be swayed by your mate Dell, who has a great tip for you. Or whatever.
Exactly. And those tipsters, again, you might find makes you a millionaire, but often it's the reverse is sadly true.
Okay. So, short term, long term, time in the market, or is it market timing? Which one do you?
Very much. It's time in the market.
It is time in the market.
Okay. And again, I should have researched the stat, but it's something like if you miss the 10 best days in a decade, it will halve the return that you could achieve. Simply because your point earlier, you were just absolutely spot on. When people react to particular news, they often overreact, and that can be on the downside as well as the upside. So trying to time the market, time when to invest, time when to exit, I won't say it's impossible, but it's very, very, very hard. So therefore, by having that pooled approach, that diversification, when those situations occur, it doesn't matter, or it doesn't matter as much. And again, if markets do fall, I use the example of the financial crisis back in 08, 09. I believe I seem to remember it was the 9th of March, 09 was the lowest point. 6 months later, markets have recovered 50%.
Yeah.
So if at that point in early March, you're panicking, worried, you exit, you then miss out on a 50% uplift.
See, this comes back to a very real experience. I remember when it was lockdown, I remember calling you, and I know I shouldn't panic, and I know things are fine, but I called you just to ask you what you thought, if there was something I should be rethinking, and you were immediately just, it'll be
No,
fine.
and again, that was another great example. Markets fell 30% or thereabouts in very short time. But having seen what had happened in the past, and again, you personally, you did not need that money at that point. So no, don't sell while the markets have fallen.
Yep.
And sure enough, here we are at record highs. So usually it's the worst thing to do is to sell.
Yeah. Okay.
And to try and time that market, as I say,
I'm trying to get this, use this as an example without being preachy, and because I don't want to be like that. But it was really important for this is a very personal thing, just to get a handle and to not second guess myself.
Yep.
That's what I'm saying, and to talk to somebody.
And that was a very scary time. There was very
very
firsts for all of us.
Sure.
Having to be shut away in our own homes and not able to step outside.
It's a good example, though, isn't it?
Really, hopefully we never have to experience again. But even then, it was still, no, this will pass, was my view. I could have been completely wrong, but thankfully I wasn't.
Yeah.
Just hold fire. Do not panic. Just almost to say don't look at the numbers at that particular time.
Yeah.
Just wait, and sure enough, things resolved themselves, markets recovered, the losses were regained, and we're back into positive territory.
Okay, so we've done quite well. We've got through lots of the things I wanted to talk about today without, I don't want to be in a position where it's, well, you should do this, you should do that, but just to understand what you can do and perhaps the approach you should have, the attitude towards doing it.
Absolutely, and that's always been my view. I'm not here to tell you what to do, it's to explain what your options are and to give you my opinion as to what is the best solution for your situation.
Okay, so financial planning fundamentals, that's James Thomas. Just to sum up, James, I think it's really important to point out everybody's different, every situation is different. These are just ideas, but these are good fundamental pillars to kind of stick by if you want to take control. And once you master that kind of first hurdle and you're ready to do something, let's just recap. What I'll give you, let me see, you've got 35 seconds.
Okay.
Starting now.
Put me on the spot. Right.
It is
again,
slightly.
Just to be aware, just to think, to have that discussion, to take that step, and then things become so much easier. and then to review and keep reviewing.
Okay. Pretty straightforward, really. If you can divorce the emotion from it and you can look at it with, through cold, hard.
Very hard to do, but as we've said
lenses.
before, it's remove the emotion.
Right. And then you're going to be okay. Right. Well, look, we'll talk to you next week. There's still a lot more to talk about. James Thomas is an independent financial consultant. Always good to talk to you.
Likewise. Thank you.
Thank you very much. Mira Business FM. It's the morning drive. We're talking gold next.
Mira Business FM.